Everyone, welcome to Thursday, where of course we do a share and review. Today we're actually going to take a look at a couple of shares. They were certainly talked about in the circles that my partner hangs around and with. And so I want to really show you the importance of perhaps that potential bar advice, barbecue advice, that sort of thing. Now, before I jump across and share my screen, just remember that this is for educational purposes only. It's not intended to be personalised financial advice. If you're looking for that, you do need to go and have a chat to your own financial advisor. If you're wanting to learn about investing, or if you have a share that you would like me to review, reach out. I'm happy to do that and point you in the right direction with my methodology. Right, let's take a look at the first one. The first share that I've got up here on my screen is ResMed. Now, interestingly enough, they have recently posted a really good profit result, and yet their share price is falling, and it's been continuing to fall. In fact, it's down around 15% for the last 12 months. That's quite a big fall, and what I'm getting at is a lot of people will think just because a share has gone and posted a really good profit result, it's naturally going to reflect in the share price. In some instances it does, but not always the case. And in my experience, I've actually seen this very thing happen, and I've also seen the opposite happen, where companies have posted very poor profit results, even losses, and yet they have gone on to run. Now, I'm looking at ResMed because, like I said, this was one of the companies that my partner's friends were talking about recently. The topic really was going that it can't fall any further, it's cheap now, it's a good investment. All of these sorts of things, which you do hear a lot of people trying to talk about with a share. Now, for me, if I look at this share just straight away like this, you can see the decline. Look how many red candles there are. There's a lot more red candles than what there is green ones. So that's immediately a really bad indicator, if you like. Let's go and put our moving average on. Now, to start with, I'm just going to put the 200 period moving average on. And I will make it exponential because that just gives us, over a 5-year, it's looking at the last 200 weeks as to the performance of the share. As you can see, the share is trading below that, and it fell below that at the beginning of March of this year. Because a share is trading under that 200 period moving average, that to me indicates that the share is on a decline. And they can fall further, and this is what people don't realise. Shares can go to zero. Now I'm just going to change this moving average. I'll make it our normal 30 period moving average. And you can see here that the share closed below it this week here, which was actually October, at the end of October last year. And it's been in a decline since then. Let's also go and put on our 15 period moving average. Right, now you can see that the 15-week moving average closed below that 30-week moving average at around December last year. And they're both pointing down. They're both saying to me that this share has got further downside to go. So it's not something I would definitely be wanting to buy at this stage, because shares can and do go to zero. Now, I'm not saying ResMed is going to do that, but when shares are trading below those moving averages, the 15-week has crossed below the 30-week moving average, it's definitely a sign for caution and to wait and see what is actually going to happen. Let's go onto the 1-year chart and take a look. And the 1-year chart brings these candles up to daily, and you can see that really, ResMed hit a high back around the 25th of August last year. Then it fell off. The moving averages crossed here at around the 10th of September. And since then, they've been on free fall. And it's not looking like it's going to be turning around anytime soon. So that is why I definitely believe you've got to heed with your stop losses and make sure that a share is trending up, because if a share is trending up, yes, it could be reaching all-time highs. However, highs can create more highs. So that's something that you need to think about when you're looking at buying shares. Let's take these moving averages off. So I'm back on the 5-year chart. This time I want to put on a trailing stop loss. I'll check ATR trailing stops. Now, I always make that multiplier 4. Right, now I'll zoom in. If you had owned this share, the blue dots are indicating where the trailing stop loss would be. Depending on when you bought it, depends on where you would have your trailing stop loss. Now, it could have potentially hit it at around this sort of week here, which was April last year. But then it did continue to run. Now, if you had your trailing stop loss, you can see by the blue line that it would have increased. Even from this period here, from about April last year, you've still seen it increase another 4 times. And eventually your trailing stop loss would have got to about $38, even though the share at its high reached about $44. Depending on when you bought it, depends on where your trailing stop loss would be, and would depend obviously as to whether you made a profit or not. Now, it actually closed below it on this particular week here, which was November last year. And you can see there, the blue lines disappear completely. So what that is saying is that not at any stage since October last year has there been any opportunities to really buy that share and let it ride up. And this is why I would not want to be buying into something like this. So you've got to be really careful if you're thinking you're going to be buying shares cheap and getting a bargain, because there could be further downside. So like I said, nothing that I would want to do. Let's take that off. Now, the next company I want to look at was also one that was spoken about, and that's called Gentrack. Look at this. This is even more devastating, if you like, than ResMed. So Gentrack had a close this week here. It was the end of October in 2024, and it closed at just over $13. You can see now that it's actually trading at $3.09. Now, in the last 12 months, Gentrack has actually had a fall of 73%. That is a huge fall. Now, if you had invested a lot of your money into this particular share, or if you have in your portfolio a lot of shares that are down around 73%, did you realize you've actually got to make up about 270% return in order to gain back those losses? So that is another reason why I do not want to try and pick shares when they are on a downslide like this. It's like what we say in investing terms, trying to catch a falling knife. You can see that if I zoom in, look at this. Last week was a negative. We had the week before was a positive. Then we had 8 weeks in a row where the share fell. Then we had a couple of positive weeks. Then we had another 4 weeks where it fell. It's just on a continual fall, this particular share. Let's go and put our normal moving averages on. So we will use the 30 exponential. And again, I will put on the 15-week. And there we go. So obviously, Gentrack had an amazing run. The moving averages crossed to the upside around November, end of November 2022. From then, it was a phenomenal run up to, like I said, the high of about the end of November 2024, where it closed at about $13. Phenomenal run. And good on you if you captured it. But since then, it's been falling. And you can see that these moving averages, if I zoom in, they got really close to crossing at around the end of April last year. They had a bit more of a rally, but they never crossed to the downside until around August last year. And then since then, it's just still down. And you can see even by the shape of those 2 moving averages, they're pointing down. So there's further downside to go in this particular share. Look at that volume for last week. That's huge. It's a huge amount of volume. There was $7.16 million worth of shares traded versus the week before, there was only 699,000. So that in itself is a huge indicator that there is more downside to go in this particular share. Let's have a look at our 1-year chart. And the 1-year chart has, yes, it crossed to the upside at around the end of November last year, but it's still pretty much been in a free fall for the last 12 months. So it's not something I would want to own. And if I scroll across and zoom in, look at this. So where I've got my cursor, which was the 4th of May, and then the following day, which was the 5th of May, got that huge gap. So that means that there was, after hours or pre-trading, either the market had closed or before the market had opened, there was a lot of selling going on this particular share. So the charts are telling us we definitely want to stay out of this share. Let's go back to the 5-year chart again, and I'll take these moving averages off, and I'll put on our trailing stops again. Right, here we go. You can see that when the share started having a good run up, you can see that blue line. Okay, and it stepped up several times until it actually hit that trailing stop loss, which was around March to last year. And you would have been sold out of this share at $9.95, thereabouts, okay? Since then, it's been going down. Now, it did, through this period here, which was end of November last year, we had one positive week, and it immediately put in the stop loss again. So if you decided, hey, this is a good share, and for whatever research you've done, you decided to get back on that particular day, you would have, applying my methodology, you would have had a stop loss at around $6.18, even though you could have purchased it, say, at $9.60. So yes, you would have lost almost a third of your money. However, if you didn't have heed to that, your share is now fallen again by 2/3. So it's only worth a little over $3 at the moment. So like I say, in the last 12 months, this particular share has fallen 73%. And only once has it shown us since the highs that there could have been potentially an avenue to have bought this share again, providing you'd used your stop loss. So that is something that I really wanted to share with you today, simply because there are a lot of people out there that like to think that they are informed, and they probably have the best of intentions, to be fair, about the shares. But in my view, it is really important to do your research based on what it is that you are wanting to achieve from the shares, and do not listen to what people are telling you for their hot tips, because it may not necessarily be a hot tip for you. When I'm helping people and coaching people with their own share trading, I get them to identify what is important to them with their shares, and I teach them methodologies that they can use in order to be able to identify those particular shares that could be potential. No, not every one of them is going to run, but I also teach people how to use stop losses in order to protect your capital. Because if you've lost 73% of your capital on a share like Gentrack, then you have to earn 270% just to get back to break even. Now, I understand that the conversation was that some people were looking to buy, others already held it and had lost that amount of money. Not exactly sure when they purchased. However, it has had a huge fall from grace. So their view now was that they were going to continue holding this share because they felt that it was going to recover. Again, in my view, you need to protect your capital, get out whilst you've still got it, and then look to reinvest into something else. Because if you lose even a third of your allocation to one particular share, it's not terminal. You can recover, but if you've gone and lost 73%, the chances of Gentrack making back 270% could be a long time in the making, if at all. I really hope that's helped. I don't like to be the bearer of bad news. However, I really want you to be informed as to how to go about purchasing shares and looking for opportunities that have a lot more potential. I don't pick winners all the time. Nobody does. However, it's about having a system and methodology in place that is going to work well for you, and you're not going to be up at night thinking, what have I done? I hope that's helped, and I'll look forward to hearing your comments, seeing what you think. And like I said, if there is a share you'd like me to review, reach out. Happy to do that for you. So until next week, take care.